market crash type of scenario, institutional capital, I think, is going to have pretty limited interest in getting long ETH with that kind of backdrop. But if you can get some, a path to a slowdown in tightening, or specifically, the biggest upside risk in my view for macro is some kind of credible treaty situation in the Ukraine conflict. And I don't mean to make light of that at all, because there's, tons of people that are dying. And I mean, it's just, it's a really horrific thing. So I don't mean to talk about it just in the context of financial markets, but that's the context of what we're talking about here. But if you can get some kind of credible treaty there, that's gonna have this setup of like, commodity prices down. They've already come off a lot off the high, but like commodity prices down, tightening expectations down, inflation expectations down, equities up, crypto up. And that would be the backdrop for, I think crypto broadly and ETH specifically to run tremendously hard if all of that kind of lines up and you end up threading the needle there. I'm not saying it's definitely going to happen, but I think that is the setup. Anywhere saying that Bitcoin was like a CPI inflation hedge. It's a monetary inflation hedge. It's a non-sovereign, hard cap supply, global, immutable, decentralized digital store of value. I've rattled that off like 5,000 times at this point. And it's a hedge against it's a hedge against irresponsibility from central banks and governments globally. And, another way of saying that is that it loves QE and detests QT. We're in a QT cycle right now, but I have a high degree of confidence that is very temporary. The market's telling you that it's temporary, and that it's closer to being done than beginning. And that goes back to my point about gonna move the fastest off the bottom. And it's that, I think it speaks to Paul Tudor Jones's moniker for Bitcoin being the fastest horse. And again, you can extrapolate that out, I think, to other pockets of the crypto market, that in a world where central banks are racing against one another to see who can devalue their currency the fastest, what are they devaluing against? And crypto, I just think it's pretty clear to me that crypto acts really well over a medium long-term time horizon as a hedge against that. It's like it's an asset class and a technology that like scoops an excess amount of that monetary supply inflation relative to other asset classes. And you can measure this by looking at like M2 money supply versus like the S&P 500 or NASDAQ or real estate or commodities or Ferraris or Rolexes or rare whiskeys, or like you can just pick an asset class, trading cards. You can just pick an asset class, and I just think crypto and this pullback notwithstanding, but over a more medium term time frame, I think it just looks like crypto is going to scoop an excess share of that monetary supply inflation. Now, to your point about JGBs and European debt, I don't have much of a view there. I think it's possible. I think there's certainly the potential for there to be so much stress in the yen or JGBs or the euro or European debt where those stress levels get to a point there, but the Fed does have to react in some way. I don't know exactly what that looks like. That would be on my list of things in terms of like shit breaking, like, euros on that list, JGBs, yens on that list, right? Like, overnight short-term funding rates is on that list, treasury volatility is on that list, credit spreads is on that list. Those are the like skeletons in the closet that you want to look out for. Overall, when I look at what the Fed can do, what they're incentivized to do, what they have done historically, all of that points to them kicking the can down the road. They're incentivized to kick the can down the road. They can kick the can down the road. They've kicked the can down the road for a long time before, and I get it. A lot of people have been talking about the early 1980s, talking about Volcker. Like Jay Powell invokes the name of Paul Volcker like it's George Washington or something like that, and I get that. But like, look at debt to GDP. We're currently look at deficits to GDP. Look at the market value of financial assets to GDP, and those three charts tell you that we are in an incomparable period of time. This is not the early 1980s, and like I know people talk about the 40s. I'm not so sure you can look too deeply into that long ago. One, because of technology, but two, just because this like don't fight the Fed, like it's just that has a stranglehold on this market to a degree that I think has never been present previously. So you take all of that, and I don't think this is like the end. Like I don't think this is like the end. It may be the beginning of the end, but I'm not even sure it's like the beginning of the end. I think it just looks like there's a pretty good chance I think it's just like another can kick. And by the time these things actually come to a head, debt to GDP, deficits to GDP, financial assets to GDP, all this money printing that have gotten us in this problem, it's not going to be boomers' problems. It's going to be our problem. They're going to be dead and gone and out to pasture. But I also don't think that it's like, that's not like 2022's business or 2023 or 2024. I'm not entirely sure it's this decade's business. So, yeah, I would be a little cognizant of being like Chicken Little, the sky is falling, right this second for the really big arc. Yeah.